Let me start with something that most real estate investors absolutely do not want to hear. If you own or invest in real estate, there's a very good chance your returns on paper look way better than they do after tax. And we're not talking about just a few $1,000s, we're talking about tens of thousands to hundreds of thousands of dollars I see every year real estate investors leaving on the table. They're not even making bad deals, they're making solid investments. It's just that they haven't modeled for that tax piece that's gonna take a huge chunk out at the very end of the deal. I've seen six-figure depreciation losses that did not reduce that person's taxable income at all. I've also worked on returns where a real estate flipper thought they were gonna pay 15 to 20% in tax, and they ended up paying closer to 30 to 40% in taxes. So today I'm gonna walk you through 5 real estate tax mistakes that are very common that you should avoid to maximize your gain on every single deal that you do in real estate. Just before we jump into the mistakes, I want to set the frame for how the IRS looks at real estate activity to begin. The IRS is not evaluating deals one at a time. The IRS is looking at patterns over multiple years. The IRS is looking at how often you buy, sell real estate, how long you hold the real estate, what type of income you have on that real estate, losses you're showing year after year. These are the things that the IRS are paying most attention to. The reason for this is the IRS wants to bucket you into one of 3 things. You're either an investor, a landlord, or a flipper. The context of this matters a lot because the mistakes are going to tie into what bucket you fall into, and that's going to drive what type of taxes you pay at the end of the year. So our first mistake is accidentally turning capital gains into ordinary income in real estate. Many investors assume I buy a property for X, I sell it for Y, I have a gain, and I'm gonna pay capital gains tax on that gain. The important thing to understand is the IRS doesn't just look at the asset, they look at your behavior regarding that asset. I'm going to explain. So for example, if you keep buying properties, renovating them, improving them, selling them quickly, and repeating this process, the IRS is going to bucket you as a flipper, not a landlord or an investor. This one classification means everything, right? So since you're a flipper or a dealer, as they call it, you're regularly doing business, and therefore it's sort of like a W-2 or 1099, ordinary income. It's not capital gains. So instead of paying around 15 to 20%, you're paying closer to 35 or 40% in some cases. This is extremely important to keep in mind if you're getting into the hustle of flipping homes. So depreciation ties into this as well. If you're a flipper, if you're holding these short term and this is regular business, you're gonna be paying taxes on ordinary income, not capital gains. Meaning you can't just take cost segregation studies and maximize your depreciation to offset gains because you're in a totally different strategy. So all said and done, you have to understand if you're paying ordinary income taxes at the end of the year or capital gains taxes at the end of the year. Let's make this more concrete with an example. We have Mark. Mark sells 3 homes this year. He nets $80,000 on the first home, $70,000 on the second home, and $100,000 on the third home. So in total, he has $250K in total gains, which he assumes he's going to pay capital gains tax on. But since Mark is holding these for a very short amount of time, he's renovating them quickly and selling them quickly, the IRS classifies him as a dealer. So instead of paying a $45,000 tax bill, he's looking at a tax bill closer to the $85,000 or $90,000. Nothing illegal happened here, no audit letter showed up, it's just that this classification increases his tax bill by double. This brings us to mistake number 2, which is passive versus non-passive income. The key thing to understand in real estate is most income in real estate activity is considered passive income. The reason it's structured this way is because IRS doesn't let you offset your real estate losses with active income. For example, W-2 income and other active business activity. So just because you bought a piece of property and you have a ton of real estate losses, that passive loss cannot offset your active income. So investors see a $120,000 loss, for example, from their real estate, and that doesn't change their tax bill whatsoever, and they're left to be a little bit confused. So in a separate video, I'm going to talk about specifically how to go from passive real estate to active real estate and how this changes everything for your taxes. This brings us to mistake number 3, which is assuming real estate is an automatic tax advantage. So there's this notion that real estate has extreme tax benefits, which is true, but it's conditional. Real estate is mainly taxed on how involved you are, and if you could turn that from passive to active involvement, that's where real tax benefits come into play. Keep in mind, you're not able to trick the IRS as to what you're doing with this real estate. They're very familiar with the structure of real estate. There's many real estate returns that are out there, and they've structured this program in a specific way where they understand exactly what you're doing when you file your return. For example, long-term rentals produce passive real estate income. A flip, or if you're a real estate agent or broker, is considered active real estate income. A short-term rental might fall somewhere in between these two. So in the end, 3 investors might buy 3 of the same exact properties, treat them very differently, and have completely different returns and tax bills at the end of the year. If you want to be successful in real estate long-term, you need to understand how tax affects what you're doing, what strategy you have, and what to do in the future. Mistake number 4 I see real estate investors do all the time is cost segregation issues and classifying depreciation incorrectly. So depreciation is one of real estate and investing's most powerful tools. Everyone has heard of this. So what does depreciation actually do, right? Depreciation creates a paper expense. Depreciation reduces taxable income. Depreciation does not increase cash flow. So what does cost segregation do? Cost segregation accelerates depreciation. Cost segregations front-load deductions. Cost segregations create large paper losses very early on. So the mistake isn't that you're not using cost segregation, it's that you're not using it correctly. You're using cost segregation without enough income to offset it. Or you're doing it without understanding passive loss limits. And you're probably doing a study without even thinking about your exit strategy. Cost segregation studies are expensive. People are spending $15,000 to $25,000 on these studies, and they're creating huge paper losses, but sometimes it's to no benefit. Remember, the timing of these losses have to match income. That way you could actually offset that income and do it the right way. So, depreciation and cost segregation studies is something you need to be a master on if you want to be long-term successful in real estate. This is a non-negotiable. This all brings us to our final mistake, mistake number 5, which is not building tax strategy into your model and your ROI figures. Most investors and real estate owners analyze deals like this, and you could probably resonate with what I'm about to say. You have the purchase, then you have the rehab, then you have the rent or sale price, and then you have your ROI figures, right? That's a simple way of breaking it down. Very experienced real estate investors will tell you in the advanced way of doing this, they ask completely different questions, and sometimes they even work backwards. Some questions they ask before buying are, will the income be passive or active income? Will depreciation offset any income I earn, and what years will they offset that income? Does the holding period align with capital gains tax treatment? What does the exit look like after taxes? For example, a great flip may look amazing pre-tax, but after tax, is it really worth doing the deal? Versus a rental, for example, may look a little modest pre-tax, but after tax and in the long term, that rental might be actually providing you way more returns. Bottom line, if taxes aren't in your strategy, your ROI figures are inflated from day one. It's as simple as that. So before we wrap this up, I want to do a self-exercise with you so you could see within your portfolio if what you're doing makes sense from a tax perspective. I want you to mentally run through your last deal or your current deal and ask yourself a few of these questions. First, do you know how the income on this deal is actually going to be classified? Is it going to be capital gains or is it going to be ordinary income? Second, did depreciation actually reduce your taxes this year or last year, or is it just creating a paper loss that is going to be carried forward into future years? Third, if you sold that property tomorrow, do you know what your tax bill will be if you had depreciation recaptured? And finally, if you have multiple properties, do you know which properties are helping you from a tax perspective and which ones are hurting you from a tax perspective? Most investors cannot answer these questions. They haven't been taught to focus on this. They focus on the deal, the number within the deal, buying and selling. They're never ever paying attention to what happens at the end of the deal's life. But smart investors understand that this is the most important piece of the puzzle, is what happens at the very end. Especially if you're holding or investing long-term, you have to have a good grasp on this because this is where all the money is made. That's why depreciation and real estate and taxes is such a hot topic. Just think about why real estate millionaires and billionaires were created. They took such a big advantage from taxes and the way the tax code was written that they became so disgustingly wealthy, but it's because they did what others don't want to do, which is understand taxes as it relates to real estate. It's a boring topic, not everyone enjoys it, but if you want to succeed in this field in real estate, you must play the same games that the real estate billionaires and millionaires are playing. There's no other option. So guys, I hope this video was helpful. If you want more videos about tax and real estate, let me know because this topic is so vast and I really want to help you guys grow your portfolio and your wealth as it comes to real estate. Drop a comment below. I'm gonna answer you directly. Any questions you have or anything you want to discuss about this topic. I'll catch you guys in the next video. As always, thank you for liking, subscribing, and I hope to make way more content like this so that you could grow your wealth.